Last week, we talked infinite banking concept. Is it a legit strategy or an insurance sales ploy? Check that one out. It was a great episode. This week, life insurance for retirement planning. Is that actually a smart strategy or a costly mistake? We're going to tackle that in the Life Insurance Financial Education podcast. So welcome. We're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Vaquero with Net Wealth Finance.
So life insurance for retirement. A lot of people in the insurance space like to talk about whole life insurance and IULs as a supplement to retirement. Some people maybe even go beyond that. So let's dive into this. And there's basically 4 different topics that I think we want to cover in this regard. And these are going to be something in relation to some other things that you can do as far as retirement. So contribution limits, correlation to other investments like the stock market, strategies as to how these can be viewed, like a volatility buffer, and then tax-free income. How does that end up working? So all of these things are things that high cash value life insurance can be utilized in retirement. And is it smart strategy or is it going to cost you? Carlo, what do you think?
Well, I think it's definitely a smart strategy. I think that's one of the reasons why we do this. Before we hop into those topics, let's talk about one of the things that is really important and what life insurance can bring to your overall retirement planning. And that is another element of diversification. There's a lot of people in the financial space who will talk about diversification. A lot of those people are really just talking about assets within the market. And they might even say, don't touch real estate, don't do these other things, just do the market. But we're talking about another tool that can be in your toolkit, high cash value life insurance. It can bring a lot of things to the table. And we're going to get into some of those details in this episode, but it is a great tool for diversifying your asset portfolio.
Excellent point, because I think that the key to making sure that you're not making a costly mistake is to not put all your eggs in one basket. So whether it's a life insurance agent trying to convince you to put everything into a particular policy, or somebody else that's selling a different product that's saying theirs is the main thing that you need to focus on. Like, I think we would just flat out disagree with that from a diversification standpoint. The reality is, what is the proper weighting that we're going to provide each independent asset within our overall portfolios? And how do they react with each other, creating a solid financial portfolio? So I think a great place to start then is correlation to other assets. Let's talk about how growth or losses are correlated with other parts of our financial portfolio.
Well, one of the things is when you have money in the stock market, that is direct market investments that can experience the great gains and the great losses that are tied to that. But whole life, it's really a completely different asset. They invest in things like AAA bonds and various other things that are very secure. And as such, it gives some pretty decent guaranteed returns, but also a very high likelihood of outperforming those guaranteed returns. And it's definitely protected from the normal market investments or the losses in the markets.
So whole life, totally not correlated on the growth or the losses of what you're going to see in the stock market. And I would also add rental real estate, or really any real estate. When you see something like 2008, where we had massive losses or reductions in value of real estate portfolios, as well as bond and stock market portfolios, people's whole life insurance, it still kept chugging along, mainly because you had really high guaranteed interest rates. But also, these companies are not trading bonds. So when you have fluctuations in bond prices, their overall general fund kind of evens that out because they're sitting on really long-term bonds that doesn't affect their profits all that much year to year. You're not going to see these big swings up and down like we do with most of our other investments. And that really gives you that disconnect and peace of mind knowing that you've got at least one asset that isn't going really far down while everything else is crashing. In fact, doesn't go down at all.
And I really like that you actually called out real estate there, because during that crash, I bought my first property in 2007. So around that time where all these things were going bad. And I'll say that not only were values down for a while, the rents were depressed for a decent amount of time because the overall economy was hit hard. So I think there was competitiveness, just at least in areas where I had properties. So a lot of things can be affected, and whole life is pretty well shielded in those circumstances.
Yeah, and you were about to tell us about the IUL also. How does that differ in regards to correlation to our other investments?
IUL is downside protected. You will tend to see or hear zero as your hero. If the market is tanking, then an IUL can have that 0% floor. Sometimes it can even have something like a 1% guarantee, and that's a great thing. But on the upside, there are things like caps that are tied to some indexing strategies, but I like to use a lot of uncapped strategies. We like to use the uncapped strategies, and I think that can be great. And you can experience really big years. 14, 15% years on some of my indexing strategies is stuff that I've personally seen.
Yeah, so the IUL, you do have correlation to the upside of the market, at least with whatever index options you have available, but you're not going to be correlated to the downside of the market. And then when we're talking other financial investments like real estate, no correlation there either. So we really just have the positive growth aspect that's going to be tied to the market, but nothing else is correlated. A really good diversification tool in addition to whole life, where whole life not correlated to any of those things on the upside or downside. And then IUL, we're just not correlated to the downside in the stock market. And we're not correlated to the increase or decrease outside of the stock market.
Absolutely.
So we know that these things aren't correlated. This is where the second point comes in, the volatility buffer. These things as a tool that we like to call a volatility buffer once we get into retirement. Why don't you explain what that means?
Well, there's a concept that we call the sequence of returns. And if your primary portfolio, where maybe the 4% rule, some people will talk about that, where you draw 4% of your portfolio in retirement. If you start taking that 4% in a really down year, that can be a big problem for how long that retirement account lasts. Since we have whole life or IUL, downside protected, that principle is not going down. So in a circumstance where there's a big market correction at the same time you're starting your retirement or starting to draw funds, you can really use something like whole life or IUL to prevent your principal from running out late in life by drawing from whole life or IUL.
Yeah, that volatility buffer can really blunt the consequences of down market years at the beginning of retirement when it comes to that sequence of returns. Great point. So when we think about those as a volatility buffer, that means at some point early on in your investing, you're going to need to think about diversifying and setting aside some money into high cash value life insurance. And that's where I think a lot of financial advisors may say that's the costly mistake, because you could have been earning 9-10% if you just put it in the market and you didn't need to bother building up that volatility buffer, because you would have had so much more money when you do get to retirement that even if it did have a down year, you start off way higher. What would you say to that?
Well, I think there could be elements where in circumstances where that could be the case, but if you run the numbers on any given period, that could also come out behind. And there's actually studies on this cash value life insurance and or something like an annuity based approach resulted in higher success rates in Monte Carlo simulations. So I think that there's good data to support that. And that is a thing to keep in mind when you hear financial advisors talk about that.
Yeah, what I always come back to is when we think about the projection in the stock market of being this 8-9% return in the future, we have to assume that it's going to be that way because of what happened in the past. But there are zero guarantees that it's actually going to happen that way. In addition, there's no guarantee that you as an investor are going to be able to stomach the ups and downs that are going to happen to the general investor that they're going to assume just buys and holds or continues to contribute throughout that whole time period. The human psyche can really mess with being that ideal investor. So if we institute a strategy that diversifies early on, it doesn't have to be a large amount of our portfolio that we're diverting to these safe aspects that will serve as a volatility buffer a long time in the future. And we can get not only the peace of mind throughout our investing career that we have that at that point in time, but also we're getting this volatility buffer when we do reach retirement. And I think that that's really key to these strategies. Nobody in the stock market is going to be able to guarantee you that you're going to get to that 8 or 9% return if you just put all of your money in any particular strategy in the market, because losses are going to happen and they can't actually hold your hand throughout the whole time. They can't keep you from hitting that sell button at the wrong time. They can't keep you from hitting that buy button. They can't keep you from going bankrupt. They don't even know when something might happen to you, where you might actually die or become incapacitated, in which case the benefits, the living benefits or the death benefits of a life insurance policy may come in and actually save the day, because there's no way you would have realized that long-term 8 or 9% growth in your other portfolio, because you either weren't alive or you didn't have the physical ability to continue earning and contributing.
I think that's the big thing too. When we talk about these 9 or 10% returns, keep in mind that that's factoring in years where you have 10, 15, 20, 30% losses. So that's what we mentioned earlier, that sequence of returns, and having a tool like life insurance can be really helpful for stabilizing your mental state in some of those circumstances.
Now, one of these points that we're going to hop into applies basically to people who have the ability to contribute way more than your typical retirement account. And so not having contribution limits on these products can be a big benefit because of the tax advantages. Tell us a little bit about that.
Well, with life insurance, you're limited based on the amount of life insurance you can qualify for. And for most people, that is going to be significantly more than they can probably afford to put into life insurance. So there's various factors that play into that, but you can get what would be a reasonable amount of life insurance and fund tens of thousands or even hundreds of thousands of dollars a year into these policies. And that's really powerful when you compare it to the $7,000 a year IRA limits or the $22,000 a year or so of 401k limits. And maybe you have your solo 401k or various things that might be 60, 70,000, but with life insurance, you can go well beyond those numbers.
Yeah, so not only do we get the diversification and creating this volatility buffer, but it happens inside of a tax advantage account. And this is where it becomes a good idea to really think about what's a good percentage that I can do that and this. Because we don't really, I know I don't advocate for putting money into life insurance and not putting it into a 401k. If somebody has significant income and the savings of putting that money into a 401k could be 35% on taxes this year, like that's a significant amount of savings. And when we're talking returns in the 5 to 7% range inside of our life insurance, 35% is like really significant, especially if we're also going to be getting gains with those particular products or those particular investments. So I'm not an advocate for doing away with those. I want to figure out how can we do both and what's a good percentage that we can do both. And now we end up with a really well diversified portfolio that's going to serve us throughout retirement.
I think that for me, there's not really a set number, set percentage. I think that we want to take into account the overall picture of a person's financial situation. And, I tend to look at it like with life insurance, it also just increases my overall savings rate because I don't lose access to that liquidity. So when I first got into this process, I was initially thinking significantly lower numbers of funding than I currently am funding at, because I didn't fully understand how flexible things could be and how much I could tap the funds if I needed to in an emergency.
So many good reasons to fund a policy and lots of ways to utilize it, not only in retirement, but also throughout our lives. So there's benefits there as well. Let's hop into the last bullet point that we had to cover, which was how do we actually access the cash value in these policies in retirement? And that's via tax-free policy loans. Tell us a little bit about that.
So I tend to think pretty much with IUL, always going with those tax-free policy loans in having that ability to possibly have some arbitrage, because you can have this scenario where you might be borrowing against the policy and growing at a higher rate, but you can also have the option to withdraw up to your tax basis in both IUL or whole life. In whole life, that tends to be what you would normally do and approach it with withdrawing up to your tax basis, all of your premiums paid in, and then taking policy loans against the remaining amount if you so choose. So these are things that, because you pay taxes on the funds going into life insurance, you have access to use those things in these life insurance products.
Yeah, I'm going to dive a little bit deeper on both of those and then we'll wrap this up. Essentially, with whole life, we look at doing withdrawals up to the basis and then policy loans after that. And the main reason we do that is because there's not likely any positive arbitrage that happens in a policy loan on whole life. If you're in a situation where you're going to get some arbitrage, you probably will not start with withdrawing that basis first. But because there's a small net cost in almost all whole life policies, we do the withdrawal the basis first, and then we start to draw income. In the IUL, however, because at the time of retirement, we will have owned these products for potentially decades. We have an experience that tells us, are we going to be earning more than 5% a year on average? And since we know that we can borrow at 5% without affecting the growth in the policy, we're going to be able to either assume that we're having arbitrage based on our past history or not assume arbitrage. If we think we can beat that 5%, we want to start with participating index loans that allows our policy to grow faster than we're taking those loans. And if we're doing that, we're not going to withdraw the basis because we could be making way more money in that situation. That may be a situation where you keep doing those participating index loans for a decade or more into retirement. As long as we're getting that arbitrage, we keep it going. But as soon as there's any question that we might not start to earn arbitrage, we can shift to a wash loan where there's no net cost between what we're getting credited and what we're paying to borrow. And it's basically the equivalent of doing the withdrawal. Because we can get that no net cost, we don't have to do the withdrawal up to the basis. Somebody can if they want to, but I don't foresee that even being necessary inside of the IUL. Any critiques about my approach there?
No, I think you're absolutely right. I think by switching to that wash loan in an IUL, it still does leave the door open. If maybe the market conditions change in the future and you want to switch back, you could still do that. But if you do that withdrawal of funds from an IUL, you lose that option. So I think that's where that math makes sense when you have that wash loan to keep it in there and possibly make a decision to change that in the future.
Great points. A lot of flexibility when it comes to loan options inside of the IUL. We get a little bit of flexibility in whole life in that basically we're probably getting wash loans, but we do have the opportunity to collateralize that cash value with an outside bank if it offers us the opportunity for arbitrage. So something to discuss with your financial advisor or your insurance agent. I think that wraps it up for this topic. Do you have a call to action for our listeners this week? It's time for this week's call to action.
I tend to say this a lot, but I think that it's worth saying again. A lot of what we discussed here is in that sentiment to diversify your asset portfolio. And I mentioned earlier, might have people in the financial industry saying to diversify in the market, but are you truly diversified? Do you have real estate? Do you have life insurance? Do you have annuities? Do you have anything like that that you are going to be protected or have the option to protect your principal in your investments when or if the market is down and you need to have income from your retirement or your assets? So that's what I want you to do. Assess whether or not you are truly diversified in your asset portfolio.
Great point. I will just echo that and say the call to action is check your current portfolio and see how all of your investments are correlated. If one aspect of the economy were to go down, does that impact your entire portfolio? Does it impact half of it? How much of it are you going to have to worry about in a particular financial event? And then plan accordingly. You may want to have a conversation with a financial advisor or with your insurance agent about how to get the diversification that you need if you look at that and you think, I might not quite be comfortable in a particular situation where things start to go south. And with that, I'm going to urge you, join us next week because we're talking financial horror stories. It is Halloween, so we think that that's going to be appropriate. We've got some spooky stories for you coming up. Well, maybe not spooky, but they're certainly going to be horrifying. And then November is going to be IUL month for us, where we're going to cover all things IUL, from what it is in its history to participation rates and volatility indexes, everything that you need to know about the IUL. I hope you join us for that. Signing off, I'm your host, James Barber, your Oregon Cash Flow Pro and licensed for life insurance and annuities across the country.
And I'm Carlo Becerra. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we'll work with life insurance clients across the country as well.
All right, take care and we'll see you next time.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.